What salary should you be giving yourself in 2025 as a sole director in your property company? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. It's a great way to take money out of your company if you're making profits by taking a salary, and this is likely to be a director's salary. However, with recent changes in the 2024 budget, the question is coming down to what is your salary going to be from April 2025? Now, the best way for us to have a look at this is to look at some numbers to show you what the impact is depending what salary you are going to take, both for you and for the company, as well as some of the statutory benefits that you'll get depending what salary you are taking. We're therefore going to dive into some numbers and see what salary do you want to be paying yourself in 2025. As a sole direct company, we now have different rules that we're working by with the recent changes in employment allowance and the recent changes to the personal allowance and different changes. So what is going to be the right salary for you? And that is what we're going to explore briefly in our video today. So the key things we now need to be considering is whether we want to be paying employees national insurance, whether we want to be getting a national insurance stamp, or whether we're looking to try and maximise for a tax point of view. Now, this ultimately means that we have a few considerations to make. Firstly, we need to consider what our company is making, because obviously if our company is not making enough money, then potentially we may not be able to take a salary. However, if our company is making a profit, the question will be what salary we want to be taking. Now, the key questions or the key target positions are going to be 12,570, 6,500 and 5,000, all for very specific reasons. Now, for our 5,000 salary, this means we're going to have no employers' national insurance. However, we're not going to get a NI stamp either, so we're not going to be ticking the box for state pension or any of the state benefits. However, at the 6,500 salary, we are going to be paying some employers' NI, but we are going to be getting our NI stamp. So that means we'll get our state pension, we'll get any SMP, SSP, etc. for state benefits. Now, our 12,571 comes into play when we are looking at our tax side of things. So this is the max that we can take without paying any income tax. At this sort of level, you will be paying employers' NI, but you'll also be getting your NI stamp. So as you can see, there is different variables that you could go under or over any of the different ones. So let's just have a quick look at the implications. So on our 5,000 salary, that means in our company we are going to be getting tax savings at 19 or 20%, 25%, depending what it is. So if you're only making a small amount of profit, it will be at the 19%. If it's at the bigger profits, it will be 25%. You're not going to be paying any employers' NI, so that means there's no tax savings on our employers' NI contributions. At our 6.5, we'll have tax savings again in the company. There will be some employers' NI, which we will have tax savings on because this is going to be an allowable expense for the business. And this will also be the same case for our 12,570. From a personal point of view, this will be using up some of your personal allowance, but you'll have some left to actually be used on other income. which could include dividends. Again, with our 6.5, you've still got some of your personal allowance left, and that can be used for dividends, or it might be used for rental income, whatever it may be for other income. We just need to remember that dividends are actually paid after tax. So you will have paid corporation tax before then you pay your dividends, but some of them will be at no tax based on the fact you've got your personal allowance left, which means you'll be able to take more dividends out at no tax, and then you'll be going to the 8.75% tax rate for dividends. And that is after you reach 12,570 plus your dividend allowance, which is currently 500. Before tax is paid. Now at 12,570 you have no personal allowance left. So that means there will any dividends, you'll be using your dividend allowance of 500, then you'll be taxed at 8.75%. So as you can see, there's a few different things that need to be considered. Everyone will be different on what they choose to have to pay. Now the key thing here is our employer's NI that is payable will be at 15% on anything above. Now the 5,000 is the NI allowance, so therefore we are going to be paying 15% on anything above that amount. This means there's an additional cost to the business to pay you that salary. However, if you are of an older age group, you may go, I've already got my national insurance stamps, I don't actually need to pay myself the salary to get the national insurance. So on that basis, you may opt to go down to a lower salary and take out more dividends, assuming you've got the profits there. For those that are maybe a little younger and have not got their 30 odd years of national insurance stamps, it may be you opt for the higher salary and take the hit on the 15% because you actually want to make sure you're getting a national insurance stamp, and it will reduce the corporation tax in the company. There may be some that want to get the NI stamp, but they want to minimise those national insurance contributions for the employer. Every situation going forward into 2025 tax year is going to be slightly different. So therefore, I would definitely seek support for anyone who is a sole director. And the key thing here is this only impacts sole directors, because anyone who's got more than one employee or more than one director on the payroll will be eligible for what is known as the employment allowance, which means that this 15%, this thing here, which is having the impact, is not going to be impacting you and your business if there is more than two of you. Now this may mean that you want to add someone onto the payroll, but the key thing here is they will have to have at least 5,000 to make sure that they're hitting the relevant thresholds to tick the boxes for the employment allowance. I definitely seek advice on what salary you are going to be paying yourself going into the new tax year to check that you are making the right decision for you, your business, and your tax position, so that you can be maximising the money you're taking out and minimising the tax from whichever source it may be. It may be paying the national insurance is actually the cheapest way to get the money out to you. It may be that that is not the best way. However, you may need to just do a few sums to check what is going to work for you in your business. As you can see, this will be a bit of a decision for you to be making depending on what you would like to be paying yourself as a salary and what you're happy to be paying from an employer's national insurance point of view. So there is a few considerations to make here, and you just need to decide what is going to be right for your company and what is going to be right from your personal tax position. I definitely advise speaking to your accountant to make sure that you're getting this right so that you don't find any unexpected consequences of your decision. Hopefully today you've discovered what considerations you need to make when looking at what salary you're going to be paying yourself from your property company in 2025. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing.